Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor. I'm really pleased to have John Rubino with me once again. Thanks for joining me, John.
Great to be back, Jay.
And it's really always good to hear your voice. It's dollarcollapse.com where people should go to because there's all kinds of goodies there. And one of my favorite things that you have up there, John, not just because you show me, or actually not because at all, that you sometimes have me as one of your top 10 videos, but mostly because of other people. I mean, I really enjoy, you have a lot of really great things there, a lot of great thinkers on the markets, and it's always a variety of people that really add a lot of value. And I should tell people that they should, I think it's once a week you do your top picks, your top 10 videos of the week, I guess, right, John?
Yeah, usually on a Sunday. And one of the nice things about the fact that this financial bubble, has gone on way longer than it should have, is that it's allowed a lot of really smart people to gain traction in this market. You know, you have a lot of people publishing in various ways really good stuff on gold and crisis investing and libertarian politics. Things that we're interested in. But, in the past, there wasn't all that much great material. Now there's a ton. There's an embarrassment of riches because we've had such a long time to develop these ideas out there. So it makes the top 10 video thing, it's easy to find 20 of them, but it's hard to edit it down to 10 because there is just so much good stuff.
I can imagine because, I don't find the time to watch nearly all of them, but if I can pick one or two of them every week, it's really very helpful, I find. So I want to thank you for that. It's dollarcollapse.com. Well, John, we've titled our show today, Interest Rates Amid Out-of-Control Spending. We're seeing money just spent as if it grows on trees. It seems to be not only a Democrat pathology, it's also inflicts the Republicans. It seems to be, ever since Richard Nixon took us off the gold standard, it's been easier and easier, it seems, to be able to spend more and more money and to really distort the markets in order to give people what they want, or at least some people what the politicians want them to have. And so I'm just wondering, how long can this thing go? We've got, what is it, our federal deficit, our federal debt is up to something like, are we pushing 28 trillion or something like that, John?
If not more now. I think 30 trillion is in the in the headlights of the federal government right now, because this year they're going to borrow as much as they did last year, which is astounding when you think about it. Because last year the deficit was 15% of GDP, some crazy number like that. Yeah. We're looking at the same thing this year. We just had the COVID relief bill get passed, and now they're talking about an infrastructure bill that is going to be in the several $trillion range, phased in over a few years, but still tons of money going to be spent. And they haven't completely bailed out the states and localities yet, which is going to be the really big bailout. So all of that stuff is coming. We're going to borrow a ton of money, and we'll break $30 trillion official national debt in the near term.
That's incredible. I mean, it's hard to get your head around what a billion is, let alone a trillion. But one of the things I noticed that really seems to be the case is that they call it the COVID relief bill, or whatever it's called. But something like only 10% or less than that actually goes to COVID-related things. So, humanities, the arts, all kinds of other things. I suppose money going to the blue states, which are running huge deficits. And then infrastructure. Will it really be infrastructure? Who knows? It's not a bipartisan situation. So obviously the party that's in power is doing pretty much what they want to do now. But how far can this go, John? How is this going to be financed? That's the big question, right? Interest rates have started to tick up. It seems to me the markets are suggesting that they've got to go higher. If you want to find people that are willing to not consume today and set aside money, then you're going to have to pay them more. You're going to have to pay more to finance this huge deficit.
Yeah, that's really the interesting thing about this moment is that interest rates are starting to go up because inflation is starting to go up. And that puts the Fed in a real bind because normally you deal with rising inflation by raising interest rates.
Mm-hmm.
But we can't do that anymore because one of the things a long period of artificially low interest rates does is it convinces people to borrow a lot of money at those low interest rates. And a lot of that money, a lot of that debt is variable rate in one way or another. Prime plus one business loan, or an adjustable rate mortgage, or it's very short term, like a lot of governments borrowed. So it's sensitive to rising interest rates. And when interest rates rise, it raises the interest costs of all these people, and it'll bankrupt a large number of them. If rates just go back to, just the edge of normal, we would see a global financial crisis because all the people with all this variable rate, adjustable rate debt or short-term debt would be bankrupted by it. So they can't do that. They cannot raise interest rates in the face of rising inflation. So when inflation, let's say it pierces 3% and change on a sustained basis, that will spook the financial markets. And normally the Fed would respond to that by tightening, but they can't tighten. So what they're probably going to try to do, now think this through for a second because it is absolutely crazy. They will try to push interest rates back down by creating a whole bunch of new money and using it to buy bonds via some kind of QE program. So we're going to meet inflation with more inflation and hope that it all works out. And that is literally it. That's the only tool the government has right now to deal with what is probably coming. And so then the question becomes, what happens when everybody figures out that the Fed doesn't have the slightest idea what it's doing? They have zero tools to deal with the world as it is. And the world as it is spinning out of control. So that could be next year, because all you would need is the 10-year Treasury bond to go from like 1.65% now to 2.5. Very easy move in that market. And that might just blow up the global financial system. So we're, Jay, we might be there finally after all this time.
Clearly Powell tested the limits, during towards the end of the Trump years, and when he let rates start to rise, and what did they get up to 2 or 3% or so on the 10-year, got to what, 3% maybe, and then then the market started to go nuts and started to head south. There is a point in which the system breaks down. We don't know exactly where that is, but it isn't going to be higher now than it was, I would guess.
Well, see, the longer you keep interest rates artificially low, the lower the limit is going forward,
right,
that people can tolerate.
Mm-hmm.
And so we don't know what it is. We don't know if it's 2.5% on the 10-year or 3%, but we know that it's lower than it used to be and that it's falling over time as more and more variable rate debt is taken on. So we're going to find out in this next cycle, because they've already announced that they were going to let inflation run hot here for a while.
Right.
So we're going to see 3%-ish inflation at a minimum, because a lot of things are going up in price now that weren't in the past. It used to be just stocks, bonds, and real estate where all this money was going.
Yes.
Now it's industrial commodities and agricultural commodities. So lumber is up, and iron ore and copper, and that feeds into the consumer price index. So official inflation is going to go up. And then we find out, what that means for the bond market, because if you're lending money in the bond market, you want a real return on your lending, right? So you want an interest rate that's higher than the inflation rate. And if inflation is 3.5%, that means the 10-year bond needs to go close to 4%, which would just be catastrophic, I think.
Mm-hmm.
So anyhow, that's where we are, and the action could start at any time.
Well, one of the things that I've noticed is that the 10-year rates are getting close to what the dividend rates are on stocks. And for the longest time, you've had insurance companies that, used to just own safe investments, treasuries and high-quality bonds, corporate bonds or whatever, and not go out very much, at least in the equity markets. But they've been forced to do that, to take on risk, pension funds and the like, that more than they would have in the past. So these are funds, depending on the nature of the insurance company and their needs, they have to they have to be able to depend on something that's stable values, in order to liquidate them as they need to, especially, let's say, for retirement funds and so forth. So what are these people going to do, John? Let's say, they almost have to keep the stock market elevated as well, because so much investment is out there in the equities markets. So much of these funds, never mind individuals that are out there buying these crazy assets.
Yeah, we can't tolerate an equities bear market now either. And see, that's another thing that very low interest rates do, is that it push people further out on the risk spectrum than they really ought to be. Mm-hmm. But that's the only place where you can find the income. Like if you're a retiree and you were thinking you would live off your bank accounts in retirement, and your bank account pays 0.5%, your financial advisor will put you in junk bonds. Mm-hmm. Or dividend-paying equities, like you said, which are not nearly as safe mm-hmm. as what you would have bought in normal times. Same thing with pension funds. So you've got people who can't tolerate higher interest rates because it will blow them up directly, and you've got other people who can't tolerate any kind of financial turmoil because they've bought things that are riskier than they can tolerate at the bad end of the spectrum. Like when risky assets start falling, pension funds will go bust, and retirees will have to go back to work, and it'll just go on and on. So you've got carnage out there pretty much wherever you look when we try to resolve these artificially low interest rates, because you can't go from artificially low to normal in the interest rate world without a huge amount of pain. And we're kind of looking at that now, because you would think a lot of pension funds would be in big trouble now that the bond market is starting to roll over. Bond prices are going down as interest rates go up. So these pension funds that weren't making very much on their fixed income portfolios anyhow are now reporting losses in their bond portfolios. So if stocks dropped as well, they would have across the board 15 or 20% losses, which mm-hmm. for a pension fund can be fatal.
Mm-hmm. And so the Fed will respond by printing more and more money faster and faster to try to keep the interest rates from rising, to try to keep the stock market elevated. Meantime, as you point out, we're starting to see inflation not just in the financial assets, but we're starting to see it in the things that really hurt individuals. The cost of living, the cost of staying alive, energy costs going up as well as food costs, and they're related, of course. And in the midst of this, of course, we also have problems with supply chains and so forth, somewhat related, perhaps a lot related to the COVID situation. So you have all these issues that are seeming to come together that are creating inflation. So the Fed will, as you say, pour gasoline onto the fire to try to put it out. They'll put more money into the system, which will cause these issues to rise and become even more problematic. Then what will they do? Price controls, as Nixon tried to do in the 70s?
Well, that's what desperate governments fall back on, because once they're out of tools, they have a choice of just letting the system spin out of control and collapse, and them being blamed for it, or trying something, anything, and price controls are usually on the list of something or anything right at the end. But, you go back through financial history and you see them cropping up all the time. The Roman Empire had a hyperinflation, and they imposed price controls with the death penalty if you violated them. After the French Revolution, same thing. They made it mandatory that merchants accept their hyperinflating currency, even though it would bankrupt the merchants, and then they executed the merchants who refused. Mm-hmm. So crazy stuff like that happens when governments start to lose control. And I think in our case, wealth taxes, wealth confiscation, capital controls, all kinds of things like that are completely possible, along with price controls, which means you want real assets that aren't subject to that kind of thing. And you want to diversify geographically. Don't just have everything in the U.S. If you've got the kind of capital that allows you to buy a Costa Rican beachfront condo or some farmland in Chile or something like that, or put some gold bars in a Swiss vault, it would be useful to do that as a way of getting some of your capital beyond the crazy stuff that might happen here. And, you can't know where it's going to get craziest. So you can't tell which country is going to be most hospitable, but it helps to know that, if you have your assets in 3 countries, and 2 of them do not go crazy, then you still have some of your capital left. That's the basic idea behind diversification. And now, more than ever, you want to do it geographically if you can.
Well, I'm thinking in terms of diversification of of different assets as well, John. So, let's say silver, for example, is an industrial commodity. It's also a monetary asset. Gold is almost purely a monetary asset, or it's for jewelry, but a lot of jewelry is monetary jewelry. Maybe owning some commodities in one way or another would be a good idea, even if you can't buy that beachfront property in Costa Rica or whatever, because I'm certainly not able to do that right now. That's for sure.
Yeah, you want to diversify in terms of what assets you own, but kind of within the broad category of real assets. Mm-hmm. So yes, own lots of different things that governments cannot just create more of and are less likely to just steal from you. For instance, your 401k is a sitting duck.
Yeah.
Because that's just a pot of money that the government can see and just take if it wants. Whereas gold coins hidden in a safe place are way harder to get to for a rapacious government. So you want to think in those terms too. Not only what is going to go up in value, but what is easier to protect when things really get going. And so, it's a lot to think about. It's a very challenging process when you're not just thinking about what is the best investment in terms of its price action in the next 5 years, but also, what's most likely to be confiscated and what's most likely to be inflated away. That's a lot to think about in this kind of a world, but we have no choice, right? There isn't a choice to not deciding is still deciding something. So we have to put some time and effort into figuring this stuff out if we want to come through it in as best shape as possible.
Yeah. 401ks are a sitting duck. That's something for people to think about for sure. And then what might be the alternative? If you take your 401ks out, you're going to pay a lot of taxes if you don't have a Roth IRA anyway in the U.S. So how do you handle that? I mean, you go buy some gold and hide it somewhere in a foreign country, but the IRS is going to ask you, do you own it? And you've got to tell them that too. So I mean, there's really no way when you have a totalitarian government. There's really not. I mean, people have taken our freedom for granted for so long, John, that I think most people aren't ready for this at all. What might evolve here?
No, I agree. We've become way too trusting. Mm-hmm. And, ask somebody who went through World War II in Europe or something like that, and they'll tell you not to trust the big systems because you can't always rely on them. And so we're going to relearn that lesson. But we have a chance before it really gets going to at least make some decisions that help us. And, physical gold and silver that you have in hand is a really good quick choice because it's harder to trace. Yes, if you pay with a credit card, there's a record of it, but still, it's not something that is just sitting there like a 401k. You've put it somewhere, and they can't confiscate silver. By the way, silver is good in this case because it's an industrial metal,
right?
So they can't just take it away from everybody because we need it for microchips and solar panels and things.
Yeah, exactly.
So silver coins, if you're going to just do one thing, a bunch of silver coins is probably the single best thing to do. And then once you've got that done, then you start looking beyond that into more complicated but maybe also useful things.
All right, we're going to have to leave it go at that, John. We're out of time already. So many more things to talk about, but we'll have you back on sometime soon, and we'll explore this and other topics again with you. So thank you so much.